Welcome to the Achievable FINRA podcast. I'm Tyler, the founder of Achievable, and we have affordable courses for the FINRA SIE, Series 6, Series 7, 63, 65, and 66 exams with industry best pass rates. Each Achievable course includes everything you need to pass the first time. A full textbook, videos on key topics, thousands of questions backed by our memory-enhancing algorithm, and full-length practice exams. You can try it out for free at achievable.me. And if you like it, use the code podcast to get you 10% off at checkout. This podcast was made from a video by Achievable's FINRA course author, Brandon Rith. If you'd like to have the visual aid of a video, please go to Achievable's YouTube channel and search for the video by the same name.
Stop limit orders are one of the 4 primary types of orders that you need to be prepared for when you sit for the actual exam. And these orders are arguably the most difficult and complex of the 4 we need to know. Don't get freaked out. It's not that complicated. If you really understand how a stop order works and a limit order works, this is just a simple combination of the two. In particular, in this video, we will be covering buy, stop, limit orders. Let's go ahead and dive into the specifics right now. Buy, stop, limit orders, just like buy, stop orders, are primarily used as a way to hedge or protect a short stock position. As we talked about before, short stock positions are incredibly risky if they do not have any kind of protection or hedging mechanism that is in the background. And let's go ahead and establish that real quick. Assume that an investor opens a margin account, which is required to sell short. They then establish an agreement to borrow stock from their broker dealer, and then they sell that stock immediately at 50. That is what a short stock position is. Borrowing a security that you do not own, selling it, and we know at some point in time that we would have to buy that stock back to give those shares back to our broker dealer. If the market price falls, that is where we're in profit territory. So for example, if the market price were to fall to 40, 30, 20, 10, the further it falls, the more profit we make. If the investor were to buy back at $10 per share, that is a $40 per share profit they have made. We still want to buy low, sell high with short stock positions. Just the weird thing is that we do that backwards. Sell comes first, buy comes second. Now that's the good to selling short. The bad is there's a ton of risk we have to worry about. If the market price were to rise, let's say substantially, the investor can lose a significant amount of money. For example, let's say again, investor short stock at 50, and then the market price gradually rises to $120 per share. If they want to close the short position at that point in time, they have to buy back at 120. That is a $70 loss per share, which happens to be more than the initial $50 short position that was established. You can lose an unlimited amount of money with a short stock position if you do not have anything to protect yourself against the risk that it imposes on you. We will talk about the mechanics of buy, stop, limit orders before the end of this video, but first let's talk about the guarantees that we may or may not have when we place this type of order. There's no execution guarantee, but there is a price guarantee embedded into this type of order. Let's focus on the execution aspect of it first. And to do that, let's paint that picture that we had before. Let's assume that an investor borrows stock from their broker dealer and sells it short at 50. If they were to place a buy stop limit order at 60, that's kind of like them placing a ceiling above themselves for risk purposes. This is an order that once the market price gets to 60 or above, the wheels start going in motion to buy back the stock and close the position. Remember, we don't want that stock price going too high when we're short stock. The higher it goes, the more we lose on our position. And establishing a buy stop limit order at 60, again, is kind of like saying, hey, once we get to 60 or above, let's start talking about buying it back and getting out of this bad investment. There are 2 reasons why there are no execution guarantees. First, if the market price does not hit 60 or above, nothing happens with this order. So if the market price just kind of meanders around 50 or goes down, the order is just going to sit there until the investor cancels the order. The second reason why there's no execution guarantee gets into the mechanics of how this order works. Once we hit 60 or above, the order triggers, and instead of it becoming a market order like it does with just a stop order, it becomes a limit order. That is why we use the term stop limit. It is a stop order up until it triggers, and then once it triggers, it becomes a limit order. Now, a buy limit at 60 says, hey, we'll buy the stock if and only if it's at 60 or below in the market. So even if the order triggers at 60 or above, if the next market price is not 60 or below, then the order is just going to sit and just wait for the market price to go back down to 60 or below. And yeah, that's a little bit of a weird system where we need the market price to go up to trigger and then come back down to execute. It's a little weird. We'll talk about why investors use this by the end of the video. Next quick thing to know about, and this is true for any order that is not a market order, so this is true for limit orders, stop orders, and stop limit orders, is that there always has to be a time specified on the order. It must be day or good till canceled. If it's placed as a day order, that tells the system, cancel this order if it is not executed by the end of the day. If it's good till cancel, or GTC as we call it, the order will sit and pend and wait to be executed. This could occur over the course of several days, weeks, or even months. Eventually, the order will either be executed or be canceled by the investor, whatever happens first. The last thing we need to cover is our favorite resource for these types of questions, and that is Slobs Over Bliss. And good news, you can use Slobs Over Bliss for this type of question. Initially, it might seem a little confusing at first, but as long as you know how to use it with a stop limit order, this is equally, if not more helpful for this type of order than we've learned with stops and limits. You can use Slobs Over Bliss for any type of order that has a price specification aspect to it. Now, going back to our example, we have a buy stop limit at 60. Now, once we are given just one price being 60, we will assume that that's the stop price and the limit price combined. You could potentially see two different prices, like it could say buy at 60 stop, 65 limit. And if that's the case, then 60 is the stop price, 65 is the limit price, but that's not what we're dealing with here. 60 is both the stop and the limit price in this example. Now let's look real quickly at Slobs Over Bliss. First thing you might note is it's a little confusing. BS, which stands for buy stop, is above the line. BL, which stands for buy limit, is below the line. And we've got both. Obviously, the market can't go in both directions at the same time, so what are we actually looking for here? And here's how you approach it. Stop is always step number one. Limit is always step number two. The order must initially trigger, so we're going to look at the stop function first. Once it triggers, it becomes a limit order. That is the second step. So with that being said, we look at BS first. That's the stop part of it. Buy stop. Given that BS is above the line, we need the market price to hit 60 or above for the order to trigger. If we do get to 60 or above and the order triggers, the order then transforms into a buy limit order at 60. BL, which stands for buy limit, is below the line. So now we're looking for the market price of 60 or below for the order to execute. Now, with everything that we've just talked about, you might be wondering, why would someone choose a buy stop over a buy stop limit or vice versa? The difference between a stop and a stop limit order is just what happens after it triggers. In most circumstances, it usually won't matter that much, but stop orders trigger, become market orders, execute at the next price. Stop limit orders trigger, become limit orders. It may or may not execute immediately. It might take some time. It might never execute if it doesn't hit the price range specified. Now that we've covered all the fundamental concepts with buy, stop, limit orders, let's pause and take a second, look at a practice question, and really test ourselves to see if we understand this concept. The question is on the board. If you want to, pause the video, see if you can answer the question on your own, and then once you hit play, we will break it down together. Okay, let's look at the question. An investor places the following order. Buy 100 shares of EFG stock at 155 stop limit. After the order is placed, EFG stock trades at the following prices. What statement is true? This is a strict Slobs Over Bliss question that really requires you to understand the mechanics of a stop limit order. So let's go ahead and put Slobs Over Bliss on the screen. We know that the stop part of the order is the first part we're going to pay attention to. So we will establish buy stop is above the line. 155 is our stop price, so we know this order will trigger if we see the price of 155 or above. Now with that knowledge, we will look at the prices that the EFG stock is trading at. We'll read these prices from left to right and assume that these were prices that were available at the time, kind of like the ticker tape that we talked about in previous videos. The first price we see is 156. That is 155 or above. So the very first price we see is where the order will trigger. Now, once the order triggers, that stop part of it It's gone forever. This is now a buy limit order at 155. And if we go back to slobs over bliss, buy limit BL is below the line. So we know for this order to execute, we need to see the price of 155 or below. And if so, great, the order goes through. Back to our prices. The next one, 157, is that 155 or below? Nope. 159, is that 155 or below? No. Is 158 155 or below? No. But the next price, 154, is 155 or below. And that is where the order will execute. Last step is just making sure we have an answer that matches with that. And sure enough, we do. The order triggers at 156 and executes at 154.